Inflation comes down, interest rates come down, new technologies move mainstream, so you have a glorious boom, falling interest rates, which means high speculation. So you get bubbles. You get bubbles like in the roaring 20s, you got bubbles in the stock market. Well, this time we got bubbles in stocks, real estate, commodities, everything. But you get bubbles, and then when those bubbles burst, when the generation that's spending, you get winter because the bubble has to deflate. The asset prices have to go down, the debt against them has to go down, and you have a depression. Falling prices is like winter, falling temperatures.
That pretty close to what I want to ask you, so maybe there's just a little bit here more to say. So today, we are going into the winter. Yes. We're seeing a slowdown of consumption, an inexorable, organic wave of slowdown of consumption.
Even despite the greatest stimulus in history, it's still slowing, yes.
No stopping it. So, but the real immediate threat we're also seeing with this is this hemorrhaging of worldwide debt. Yeah. So what is the relationship between this organic slowdown of consumption and what seems like a random mismanagement of the world banking system? How is that actually a repercussion of the seasons of the economy that we're seeing this tremendously mismanaged debt?
Well, it's just human nature. If things are growing rapidly and people think, oh, real estate can never go down, tech stocks can never go down, and interest rates get low, and on top of that, the government makes them even lower. Every time we had a downturn, the government would lower interest rates lower. People speculate.
Right.
First tech stocks bubble, then real estate, then emerging markets like China and India, and then gold and silver and commodities. I mean, it's been bubble after bubble after bubble. At some point, the demographic trends driving the whole thing, the technology trends peak out and turn down, and then of course the bubbles deflate. You can't keep investing in a bubble that no longer exists. So the bubbles deflate, and all the money borrowed against all that investment and all that real estate has to deflate, and that destroys money. People think the government creates money. Government doesn't create money. The private banking system created $42 trillion in private debt in this last boom. 3 times what the government has created even after the crisis. At the top in 2008, it was 4 to 1. Private credit is the biggest driver of bubbles. And when the private
if I can interrupt you,
yeah.
if that concept even isn't crystal clear, in this book there's a great dissertation on the creation of money.
Yes.
And the idea in the banking system in fractional reserves, meaning if a bank takes in 1,000, but it can loan 900 against that, you're creating money, and that's what Harry means by the private sector.
And they keep doing it.
Over and over and over again, because the next guy is going to take the 900, do something, and they can put it in the bank and create 800 out of that, et cetera, et cetera. I want to real quickly read just the opening of the book to get into where we are now and where we are today in the crisis today that we're in. And this is called, in the introduction, The Economy on Crack, the End of Keynesian Economics. And Harry writes, imagine someone very close to you, someone who is part of your everyday life and upon whom you depend is a drug addict. The person goes cold turkey one day and inevitably begins to suffer symptoms of withdrawal and detox. Along comes the drug dealer and he begins throwing not just more drugs, but harder, more addictive drugs at this person. Do you chase away the drug dealer and nurse your friend through detox, knowing that this is a difficult period, but a necessary part of the process? Or do you welcome the drug dealer and actually cheer as more drugs are taken? This might sound a bit outrageous, but it is exactly what we are experiencing in our economy. The patient, quote, or slash friend, is the economy in which we all live. The drugs are debt, interest rates, and printed money, and the drug dealers are the central bankers and the federal government. In a strange, perverse world, our markets are cheering as the patient is given more of what caused the illness in the first place. So what I want you to tell me here is, when the Fed took their actions, what was the immediate result, and what's going to be the long-term result of what the Fed's been doing to try to reverse things?
Well, first of all, you can't prevent a bubble after it's happened. They let the bubble happen. They pushed interest rates down to 1% and then 0. They now recently put $2 trillion in the banking system to keep it from falling on its face because it was melting down. But all policies allowed the private banking system to lend as much money as they want. Fannie Mae, Freddie Mac took those loans and allowed the banks to lend more. In other words, banks didn't lend against deposits anymore. They were borrowing from Fannie Mae, Freddie Mac, and Wall Street to lend, which is borrowing to lend to people who borrow, which is double borrowing.
Right.
So we created more leverage. The government said, hey, the free market system's working fine. We don't want to mess with it. And we created this big bubble. So when it starts to break down, does the Fed want to admit, oh, we shouldn't have done this? We shouldn't have let this happen? No, we want to clean this thing up and hope it goes away. We want to put enough money in to turn around the economy, save the banks so they don't go under, because the banks go under, the whole system goes under. That was not the right policy. The policy should have been, we have a huge debt crisis, huge credit bubble. We need to deleverage this bubble in a sane way, not like the 30s cold turkey, not like the Japanese with endless methadone. I mean, Japanese 20 years later are still bringing the patient down. That's a little too slow. The government should have said, look, we're going to come up with a 2-3 trillion fund, about the amount of stimulus they came up with. We're only going to give banks money who write down loans for consumers. We should have never lent this money against houses. Houses shouldn't have doubled in 5 years. The banking system made that happen. People got sucked into it.
Yeah, the great thing about the book on this is while Harry's going into where we are, how we got here, and how bad it is, there's some really brilliant work in here in terms of what should the government be doing, what should business be doing, what should individual investors. And your dissertation on government handling, some suggestions on it, I just can't understand. They're so sensible, but
they'll never
read the
happen.
book. We'll see if we can get to it. Yeah, maybe they'll never happen.
Well, they'll happen in the crisis. They won't happen before.